Reduce risk with smart diversification in trading. Welcome to this educational video on reducing risk with smart diversification in trading. Whether you are new to trading or have some experience, risk management is fundamental to success. Diversification is not only a smart strategy, but a necessity to protect your trading portfolio from unexpected market swings. In this video, we'll break down what diversification is, why it's critical, and how you can implement it effectively. By the end, you'll be equipped with practical tools and insights to trade smarter and build a more resilient portfolio. Let's dive in. Diversification at its core is about spreading your investments across a range of assets to reduce exposure to any single asset's risks. Instead of putting all your eggs in one basket, diversification invites you to place your eggs in multiple baskets. But here's the key. It's not just about quantity, it's about strategy. For diversification to work, you need to select assets that react differently, or ideally inversely, to market changes. For instance, when stocks in one sector are performing poorly, an uncorrelated asset, such as a commodity or bond, might be performing well. This balance reduces the likelihood of your entire portfolio suffering during market downturns. At its heart, diversification is a safety net. It won't eliminate risk entirely, but it's designed to minimize losses and create stability for long-term gains. Retail traders often face limited resources, making diversification a critical principle to reduce risk without needing a fortune to invest. Unlike institutional investors with vast portfolios, retail traders must manage their capital more effectively. Imagine you invest all your money in a single stock. If that stock drops, your entire portfolio suffers. However, if that same stock is part of a diversified portfolio that includes other asset classes like commodities or bonds, the effects of that loss are cushioned because the other assets may hold steady or even rise. Diversification also helps retail traders withstand market volatility, inevitable in the trading world. It reduces your portfolio's dependency on one single market trend or economic event. In short, diversification prevents one bad apple from spoiling your entire basket. Now that we understand its importance, let's explore how you can diversify effectively. Diversification isn't just about picking random assets, it's about being deliberate and strategic. Let's look at 3 key elements of smart diversification. Asset classes. Your trading portfolio should span multiple asset classes, including equities, stocks, ownership in companies; commodities, physical goods like gold, oil, or agricultural products; bonds, low-risk fixed income investments; cryptocurrencies, digital assets like Bitcoin or Ethereum. Investing across these different categories allows you to leverage unrelated market behaviors, as asset classes often perform independently of one another. Correlations. Not all assets are created equal when it comes to diversification. Some move in similar patterns, while others may have an inverse relationship. For example, when equity markets fall, bonds tend to rise, a key benefit of mixing these two asset classes. Research how correlated different assets are before incorporating them into your portfolio. Market conditions. Markets are constantly shifting between bullish, uptrends, and bearish, downtrends phases. Diversification ensures your portfolio remains flexible, regardless of the market cycle. A robust portfolio can adjust well to sharp changes in market sentiment. You might wonder, why go to all this trouble to diversify? Let's discuss the tangible benefits of this strategy. Stabilized returns. Diversification provides a smoother ride by reducing the extreme highs and lows of your portfolio's performance. While the returns might not always be astronomical, they're consistent, which is vital for long-term success. Protection in downturns. Imagine an economic slowdown crippling the stock market. A properly diversified portfolio ensures your investments in other sectors, such as commodities or bonds, provide a safety cushion, helping to mitigate losses and buy time to course correct. Exploring growth opportunities. Diversification introduces you to various markets and industries, some of which you may not have considered before. This not only spreads risk, but also opens doors to growth areas that might outperform traditional investments. Think of diversification as building a solid foundation. Without structural support, even the grandest buildings will collapse. Similarly, without smart diversification, even the most promising portfolios are vulnerable. Now comes the actionable part. How can you start diversifying your trading portfolio today? Here are practical steps to follow. Start with research. Begin by identifying different asset classes and analyzing how they have historically performed under different market conditions. Look for uncorrelated or inversely correlated assets to build a balanced portfolio. Allocate wisely. Determine how much of your capital should go into each asset class. A beginner might allocate 40% to equities, 30% to bonds, 20% to commodities, and 10% to cryptocurrencies. The proportions will vary based on your risk tolerance and investment goals. Monitor performance. Use tools and software to track your portfolio's movements. Regular updates on performance will help you identify areas for adjustment as market conditions evolve. Adjust regularly. Diversification is not a one-and-done process. Revisit your portfolio periodically. Some assets might lose their edge, risk levels might change, or your goals may shift. Make it a habit to review your allocation strategy every 3 to 6 months. Following these steps ensures you're not spreading yourself too thin while still maintaining a well-diversified portfolio. When diversifying, it's easy to fall into traps that could dilute the effectiveness of your strategy. Here are 3 common mistakes and how to avoid them. Over-diversification. Investing in too many assets can make it challenging to manage your portfolio. Instead of spreading too thin, focus on a diversified but manageable mix of investments. Ignoring correlations. Diversifying into similar assets doesn't reduce risk. For example, buying stocks in different tech companies isn't true diversification, as they are likely to react similarly to market changes. Diversify across different industries and asset types. Not reviewing regularly. Markets change, and so should your portfolio. Failing to reassess your diversification strategy could leave you exposed to unnecessary risks or missed opportunities. Avoiding these mistakes ensures your diversification strategy remains effective and adaptive. Let's look at a simple example to see diversification in action. Imagine Trader A and Trader B each invest $10,000. Trader A invests everything in a single tech stock. Trader B spreads their investment across tech stocks, gold, bonds, and a small cryptocurrency allocation. When the market enters a downturn, causing a 15% drop in tech stocks, Trader A faces a $1,500 loss all at once. However, Trader B experiences a smaller loss in tech stocks, but it's partially compensated by gains in bonds and gold, leaving their overall loss at only 5% or $500. This is the power of diversification at work. Another example, during the 2008 financial crisis, portfolios heavily focused on equities suffered significantly. However, portfolios invested in bonds saw a rise in value, demonstrating the importance of uncorrelated assets in turbulent times. Case studies like these emphasize how even a modestly diversified portfolio can stand strong when markets shake. Some retail traders worry that diversification may limit their returns. While this concern is valid, it's important to remind yourself of the primary goal: steady, long-term gains and risk reduction. If you're just starting out, diversification doesn't mean taking your existing $1,000 and spreading it into 10 ultra-tiny slices across random markets. Start small with 2 or 3 asset classes where you feel confident. As your portfolio grows, you can diversify further without compromising returns. Remember, the goal of trading is to stay in the game over the long term. Smart diversification is the tool that keeps you afloat regardless of what the markets throw your way. To summarize, diversification is the cornerstone of risk management, helping to reduce volatility and protect your capital. A well-diversified portfolio balances asset classes, considers correlations, and adapts to market conditions. Avoid pitfalls like over-diversification, ignoring correlations, or failing to review your strategy regularly. By incorporating these principles, you'll be building a portfolio designed for consistent, long-term success. It's time to take control of your trading journey. Start diversifying your portfolio wisely and reduce your risk exposures today. With smart diversification, you can trade better and achieve your financial goals sustainably. If you found today's video helpful, please like, subscribe, and share it with someone who could benefit from these tips. Thank you for watching and happy trading.